everyone. Happy March. Welcome you joining today's class, 2021 New Tax Updates and how Biden new tax policy will impact real estate. I'm Pauline Lam from Kota Realty, your 2021 co-chair, Education Committee, West Gabriel Valley Realtors. A friendly reminder, all participants will be muted in the meeting. Should you have any questions, please enter it into the chat box. Speaker will answer your questions during the Q&A section. This section is being recorded and will be available on the YouTube channel, West Gabriel Valley Realtors. Now, I'm so glad to invite our committee member, Bernadette, to introduce today's special speaker, Mr. Jeff Huang. Bernadette, the floor is yours.
Thank you, Pauline. My name is Bernadette Burkett with Pinnacle Real Estate Group. I'm honored to introduce our speaker, Jeff Huang, on behalf of Western Gabriel Valley Association of Realtors. Jeff Huang is a seasoned certified public accountant with over 20 years experience in public accounting, including experience in Arthur Andersen, one of the big four accounting firms, and senior management experience as a CFO and a controller in a Fortune 500 firm. He specializes in small and medium-sized business management and tax planning, real estate taxation and planning, foreign nationals taxation, IRS, audit representation, startup business, accounting, financial reporting, and management consulting. Jeff received his master's degree in business administration from University of California, Riverside, and bachelor's degree in chemistry from one of the top 10 universities in China. Besides being a tax professional, Jeff has a contract license and an inactive real estate broker license. He specializes in taxes and accounting related to real estate. Proud to a member of Western Gabriel Valley Realtor Association, Jeff would like to assist real estate professionals to maximize the tax benefits. Jeff is currently serving 2020 to 2021 president of CACPAA, Chinese American CPA Association. Let's welcome Jeff to the 2021 new tax updates and how Biden new tax policy will impact real estate webinar. And now here is Jeff Huang.
Thank you, Bernadette, and thank you so much, Pauline and for arrange the meeting for today. I appreciate all your time and make those happen. First of all, I'm so proud to be the member of West San Gabriel Valley Realtor Association. So I'm the member as you. So even though I have the realtor broker's license, but I don't practice, so I'm inactive. So you won't see me have the listing on the MLS, but I do like you, we go do the same thing. So that way I understand more about as a real estate professional, what is our everything, how we go through. So today I want to share with you some new things about 2021 on the tax update, and also how our President Biden, the new tax policy will impact the real estate side. So let me share my screen on that. I would like to say that 2021 is very special for 2021. How to plan ahead as a real estate professional. So that's our main topic, we talk about that. So today we go through the things is about us as the real estate professional. What is about our tax tip, and what's the major deductible expenses, and also any credit related to the COVID-19, and also some overlooked deduction we might not see, we might forget in our tax return. And also most important is about the tax planning. So the next things I would like to talk about is about our clients, about the real estate. So how the President Biden new tax plan will impact the real estate side, how we can plan ahead to take advantage for those new change. And lastly, if I have time, I would like to share some of useful tips to share with you. So the first step, I would like to talk about us as a real estate professional, how we take advantage for the new tax law. So I would like to say that 2021 is very special. Let's take a look at the time frame on the 2021. So in December 2019, and we passed the Secure Act. That's for Retirement Enhancement Act. And also on March 2020, passed the CARE Act. That's for the Coronavirus and Relief and Economic Security Act. And also have November, we had the president election, and January 2001, we had the new president Biden, and also we have a vaccine, and also no more stay-home order. So for 2021, that's the challenge, opportunities, and change ahead of us. So first one, we take a look at what is ahead of us. Everybody will know that President Biden proposed 1.9 trillion stimulus check plan. So let's take a look at all those breakdowns. The first one I would like to draw attention is around 54%. Is about 1 trillion is on the direct act. And also we have about 440 billion for the community support. So about 23.8%. So, and also we have the national vaccination programs and also another information technology programs. So let's take a look what applicable to us. So the thing is, everybody will know that the other third round stimulus check is on the top, it is on the way. So the first one, for individual, will get 1,400 checks if making less than 275,000 AGI, adjusted gross income. So for the family, if married couple, if the income below 150,000, and you will get like 2,800 checks. And children and adult dependent and also eligible. So, and the total payment will be around 422 billion. So that's on the top for the third round stimulus checks. Okay, so let's take a look as a realtor, how we plan ahead for our 2021 tax filing. So let's take a look at the major deductible expenses. The first expense is auto expenses. So as a real estate professional, we drive a lot. So there's two ways to calculate the auto expense. First way, you will use the simple method, which is the standard mileage deduction. In 2020, is 57.5 cents per mile. The things I would like to draw attention for 2021 is reduced a little bit. It's only 56 cents, so about 1.6 cents less on that. And also you can use the compressed method. What I mean the compressed method, so you use the actual expenses, including the maintenance, gas. One thing I would like to draw attention, electricity. Because some of you might driving the electricity car, so you might use the electricity at home. So don't forget that right now we also can count on the compressed method. And also the parking, lease costs, car washes, tire, the auto license, and the other things is the depreciation. About the auto expenses, one thing I would like to draw attention with my experience with audit representation, as looking on the portion on the business use. So that means that, for example, we spend like 1,000 on the car maintenance, and we only drive 75% of car as the business mileage. You only deduct 75%. In this case, 75% of $1,750. So that means that you cannot deduct all of the actual expense, only count on the business portion. So the second thing is for the marketing. I know that as a real estate professional, we have the open house side, we spend the listing yard side, we prepare the flyers, and we have our own business card. And also right now, because the social media, so we have a website development, we have our own Instagram, we have own Facebook. Don't forget, those are the expense we can deduct as a real estate professional. So as you know that like for established real estate professional, maybe your cost is less than the new real estate agent. So that way we and keep all those expenses, and you can deduct. So the second thing is for license and dues. So I know that I've already paid the MLMS, the NAR dues, and also associations, and that's fee, and also the brokerage fee. And don't forget that the Chamber of Commerce, and you can also deduct on those stuff. So that's belong to the license and dues. And the next thing is education and training. Yeah, so if we go to those education training, and those expenses can be deducted. I know that some of you taking online courses or maybe have some coaching. If that's related to the real estate and relate to your professional, definitely that's education can be deducted and keep the receipt. And others, I mean, you can see that the meal travel, and I would like to bring attention for gift. The gift is belong $25 deduction limits, so we don't need to ask for the price information. For couple is $50. So if more than $50, we need to ask the client information on those stuff. And the other thing is the office supply, and also have the legal professional, and also have the equipment. So that is the major deductible expenses. And some of the overlooked deductible expenses, we take a look at the home office expenses. Especially COVID-19, a lot of us work at home, use the home office. So the requirement for home office, you don't need to have the separate room, as long as the dedicated area should be fine. For example, if on your living room, you have the dedicated area for your office, so you can count as a home office. So for the home office, you have two ways to calculate the home office. The first step is the simple method. So basically, we calculate how many square feet you have for the home office, and times $5. They do have the cap for maximum of 1,500 for 2020 on the tax return side. So the second method is for the compressed method. So for the compressed method, it's very similar as a car. So we take the portion of the home office. So we calculate the actual, including insurance, the mortgage interest, or you don't have home, you rent, and the property tax, and repair and maintenance, and utility. Again, if you use the compressed method, and we only take the portion on the home office, so we cannot take the whole expenses for your house. And the other things we might overlook is the retirement plan contributions. So when we make income and we try to reduce the tax, one of the technique we might need to consider is retirement plan contribution. So let's take a look what kind of retirement plan we have. Most of people will know that we have the traditional IRA or Roth IRA. So like if your age less than 50 years old and 6,000, and they do have the cap. So if you're single, it cap out the income 75,000. So if you have job, the AGI is 124,000, you might cap out. So that's have the income limit. The other things I would like to draw attention is called SEP IRA. SEP IRA, the calculation is 50,000, list of the 50,000 or 25% of the net income. So if we self-employed, we use the net income from the Schedule C. If you have the S corporation, it will based on the wages you pay from the S corporations. And also, I would like to draw attention for the solo 401k. So for the 401k, individual can contribute up to 19,500. So if you're over 50 years old, and it's about 26,500. And also the company can do the matching, 25% of your compensation, so to match you. So that way, they do have the cap 57,000 for those less than 50 years old, and 63,500 for over 50 years old. The last thing I would like to draw attention is called defined benefit plan. So we look into that traditional IRA, we have 6,000. SEP IRA is least of 50,000, 56,000 or 25%. So for the defined benefit plan, it can go to up to maximum 230,000 for 2021 and 2020. 2020. So that depends on your age and depends on your income. So we have the actuary to do the calculations to give you the amount you can maximum to put away on the retirement. So the reason I would like to bring up the retirement because for 2020, we might have some income and we try to reduce as much as possible. So that's one of the way we use the retirement as one of the very good technique. I use the retirement to reduce the income and also to do the saving. Okay, let's take a look at the tax strategy for real estate professional. So the first one is everybody know that Section 179. So if we buy the equipment, we have two choices. The first choice is do the depreciation over the year. For example, we buy the computer, so we could depreciate over 5 years. So with Section 179, you can expense in the same year. And the other things I would let draw your attention, maybe we think about the S corporation. S corporation stands for small corporations. So the beauty for S corporation is reduce the payroll tax. So that may be something you might consider on the S corporation. But each of you have different situations, so that's based on your situation, and make sure that S corporation makes sense to you. The other things I would like to draw attention, maybe you might consider hire your children. So because if we make a lot of income for 2020, and we might be on a higher tax bracket, which around highest 37%. So if you hire your children, you might shift the income to your children, and then your children most likely on a lower tax bracket for that. And also, if you pay the wages to your children under age 18, it's not subject to payroll tax. But that's have one condition. It's not under the corporation. So if you're sole proprietor, you're self-employed, you can consider pay your children under age 18, and which is not subject to the payroll tax. The last thing, and the most important, we need to keep the good records. So the way you work, if you submit a tax return, and if no audit, everybody is 100%, everybody 100% correct. But if you come down to audit, every dollar amount, and us will look up to the records, look up to the receipt, and look up the backup, look up to the cancel check. So that's I would like to draw attention with my experience for the audit representations. Good record is very important. So let's take a look at any credit related to the COVID-19. The good news, I know that we have the first round and second round on the stimulus check. And for those didn't receive the check in 2020, you might be qualified in your 2020 tax return. The reason why, the first stimulus check and second stimulus check based on your income from 2018 and 2019. So if your income's high, in 18 and 19, you don't receive a check. With COVID-19, some of our income might get impacted. So we make less money in 2020. Right now, it's still the chance for us to claim the stimulus check in the 2020 tax return. So that way, you will base on if you're single, is 75,000 or below, you will get 1,200 for the first round and 600 for the second round. And every $100 you above $75 and $5 less. So that way, you can check whether you qualify the stimulus check in 2020. And that's the reason I will bring up attention and we talk about the retirement. So maybe when you file the tax return, you can see that which way is work best. So if you reduce your income, you might be qualified on the stimulus check for 2020. Good news for those baby born in 2020. That's very good news. So for the stimulus check, the newborn baby might not get the check, but now is the time for you to receive additional 1,100 credit. And also, you can take a look at the newborn baby check, and he or she might give you the tax credit around 3,100. So they born in the right time. Right now, I would like to also draw attention. Don't forget to check the support from the government. So I list out the link for the federal and state. So you can check, they have the different program to support us as a real estate professional and support our client if they have the problem for the real estate side. So that's federal side and state side. And also don't forget, we check on the state and county and city. So those are the link you might to look into that. The next things I would like to share with you for the CARES Act. This has some special incentive for those who has C corporations. So the C corporation is net operating loss because the COVID-19. If we lost the money in 2020, and if we make profit in the past years, we can request for the credit for the refund if you lost for 2020. So I give the example here as a C corporation. In 2020, because COVID-19, we lose 900,000. But if we take a look the previous year, we make profit and we pay the tax as C corporation. With the CARES Act, so we can carry back for each year until you can write off. So in this case, for 900,000, we carry back for 5 years. So for the last 5 years, as a C corporation, we pay 243,000 tax. So with the under the CARES Act, we can claim the net operating loss and carry back as a C corporation. In these examples, we will receive the refund is 243,000. Okay, let's go to the part 2. Take a look. President Biden, most likely the new tax plan in the coming the end of the year or in coming years. So we talk about the tendering change. We talk about the base step-up basis and also the capital gain and also the primary home. So let me summarize. So President Biden had a new impact. I will say that it's a good thing, bad thing, and the worst things. The good thing is he proposed the first-time home buyer we get the tax credit is $15,000 for the tax credit. So that makes it, as a real estate professional, we have more first-time home buyer because people can use this one to work the down payment. So they can, most likely, they might be qualified the new house. So that way is the good change for us. Let's take a look at the bad things. Because the executive order extend foreclosure and evictions till June this year. So right now, maybe some of the house we sold, we had problem. We had a problem to get the tenants out. So that's little bad things impact a little bit us on that. Let's take a look at ugly things. President Biden is not the big fan of real estate. So he might propose to eliminate several real estate tax breaks. So let's take a look what he impact on those real estate side. The first step is the passive loss for the rental real estate, because currently we have 25,000 loss if we have a rental real estate, and we can deduct the 25,000 up to 150,000 income, but most likely he might take out for the middle income people. So that might impact the people who have the rental real estate and the loss. And also testing on the long-term capital gain on the income above 1 million. So instead of 15% long-term capital gain or 20% capital gain, and it's going to tax on the ordinary income tax rate, which about 37%, most likely 39% on the long-term capital gain. And also he proposed most likely on the tendering exchange. So he might be phased out tendering exchange. And also we use the faster depreciation write-off for the certain real estate. He might be not favorable for those stuff. So the other things is regarding the QBI. Right now, as the real estate professional, or we use the rental as its business, you can qualify 20% of the deduction on the income tax side. So most likely that portion might be phased out. So we take a look at these ugly things. Let's take a look how we plan ahead. So they have the rule, we have the way to plan ahead. Let's take a look like how we plan ahead for that. So as we mentioned that we still have section 121. So that's exclusion of the gain from the sales of the principal residence. So we still have 2 out of 5 years. Each of us, we qualify 250,000 capital gain exemptions, and couple is 500,000 exemptions. So that might be, we need to plan ahead if we're selling the principal houses, and make sure that we leave that in our main home as principal houses more than 2 years to qualify those capital gain exemption. The other new technique, it's not new technique, it's existing for a while, but it's not like draw a lot of attention. It's called section 453. It's called installment sales. So if the capital gain rate increase, we can defer the tax on the capital gain by using installment sales. So the way it works, for example, we sell 1 million houses and we gain about like 400,000. So right now, the way it works, we've gained 400,000, we might be taxed in 1 year to pay the capital gain. So we can defer those gains by using section 453. So that means that in 1 year, I can pay the capital gain 50,000, and the second year I pay 50,000. And also, if you have making less income, you can call out the capital gain and you can pay. So that technique is called installment sales. And also installment sales, most people will think about like when you sold the house, you want to get the money you control on hand. So if you do the installment sales, that means that the buyer, the buyer might get the title, you might not get the money. But one thing I would like to draw attention, we can set the trust. It's called deferred sales tax, a sales trust. So you get the money from the buyer, put the money on the deferred sales trust. So that way you can control, the buyer cannot control the money in the sales trust. So you can control the money in the sales trust. And then every time you can control how much you will pay the capital gain by using section 453, the installment sales provisions. So the other technique is for charitable remainder trust. So some of you might be maybe think about to reduce the tax. And that's one of technique we need to, you might need to think about that. The other things is for donor advice fund. So right now in 2020, all the cash donation is 100% deduction. So that means that, for example, you're going to put, you donate the money to the church or the nonprofit organization, but you don't want to donate all at one time. So you can put the money on the donor advice fund. The same thing, you can deduct the whole donation in 1 year, and the church or nonprofit donation, and we base amount you request to them. Yeah. So the other things maybe family foundations, and also one thing I like to draw attention, we can use the sections 179 for election to expand certain depreciate business asset. I know I need to about my time. So one thing I would like to draw attention for the tax tips, because COVID-19, we work at home a lot. So for those have a corporation, I would like you to think about the new tax law, the section IRC section 139. So as the employee for your own corporation, you can make the tax-free reimbursement for the home office expenses. So that means that including the equipment you purchase, internet, cell phone, headset, laptop, desk, and any chair and any office supply. So that portion, the reimbursement, is tax-free. So that's based on IRC section 139. So other things, maybe you set the accountable plan, so that do the reimbursement for that. So, and thank you for your time, and thank you for your time. I thank you for the opportunity for me to like share my knowledge, and also a little bit tax tip to each of you, and all the best to your real estate career. So right now I'm open to questions.
Hi. Okay, I think I've seen a few questions. Okay, the first question I got is from Joanna. She said, what kind of information from client for gift over $25?
Yes.
Maybe what kind of information from client?
Okay.
Okay.
Very good question, Joanne. First one, let's take a look this way. If your expense you deduct on your side, you should be the income for your client. So if we deduct the gift over $25, and they had to be reported as the income. So we need to if those gift over 25, we need to have those informations, Joanne. First one is a client name, their social security number. Yeah, and also, if those gift like for couple is $50 for couple, and also maybe you can give to the kids, like each of them like $25. Yeah, I know that it's very tough. As the real estate professional, we give the client gift, and sometimes we on the gray line whether we deduct or not. So if we deduct, and later when I audit, and they will ask us all the documentations. Yeah.
All right, thank you, Jeff. And the second question I have is from Kevin Yan. He says, if the home was purchased in 2020, can you still get $25,000 tax credit?
You mean the 15,000? 15,000? You mean the
25,000? Yes. Tax credit.
Okay. We talk about the President Biden's new tax law on the first home buyer, but right now it didn't pass. So that's on the top. So most likely he will pass on the end of the year. So some new change on the real estate side. Yeah. So to answer the question, now I don't think they can retro back on those stuff. So they will set the more clear guideline when they pass the law.
Okay. On the third question is from Joseph Yan. Is how about the step-up basis item?
Yes. Let me explain to the step basis, and also that's one of the tax break for real estate. So let me give you examples. the house purchased in San Marino, maybe about 30 years ago, maybe about 50,000. So at the time when people go to heavens, and the house in San Marino is worth 3.5 million. So that means that when people go to heaven, we use a step basis. So the house, the cost basis is not 50,000. So right now it's 3.5 million. So if the kids get a house as the estate, so right now they sell the house, and most likely they don't need to pay the capital gain. So that means that this tax free for the step basis. So for the new tax law President Biden proposed, he might take out the step up basis. So if the step basis was take out, let's do this way. So the house is 3.5 million we sold, and the house only purchased around 50,000. So that means that the gain is 3.45 million. So there is a lot of capital gain for the houses. So in my personal opinion, so we have to be plan ahead, do better tax planning if that step basis tax law pass. Yeah. So and also might be impact our real estate professional, because maybe our client might not want to sell the house during that time.
Thank you, Jeff. And this is from Vincent Howe. For Section 121, do we need to own the principal residence for 5 years, or is fine to just own the house for 2 years and live inside 2 years to qualify for Section 121?
Yes, that's a very good question. For Section 121, that's 250,000 exemption for single and couple 500,000. So to answer questions, the first one, you have to live 2 years as a primary home. So that means that you don't need to own the house for 5 years. And the 2 years just look back period for 5 years. So let's use these examples. So let me give you first scenario. We purchase the house 2 years and live there 2 years as primary home. We definitely get the exemption, capital gain exemption, 250,000 for single and 500,000 for couple. That's a scenario one. The second scenario is we own the house for 10 years, and we live the house once on and off. So sometimes live 3 months, sometimes live 6 months. So right now with Section 121, we look back for 5 years. We're looking for 5 years. If as long as you add up 2 years as the primary home, you still get the exemption. So example like this way. So for the last 5 years, we sold the house. We look back for 5 years. The first year we live in 6 months, and second year we live 3 months, and the third year 9 months. As long as you add up 24 months, you will get the capital gain exemption. So that's we need to plan ahead. That's when we sell the house, we know that we close to 24 months. Please make those 24 months happen. That way you make the capital gain exemption. And the one thing I would like to draw attention for Section 121, for married couple, as long as one party live there for 2 years, and you still qualify for the capital gain exemption for couple. So that means that your other spouse, he or she don't need to live there for 2 years. As long as 1 day should be fine.
Okay, thank you, Jeff. And this question is from Huang. If we receive W-2, can we still deduct all the expenses if we work from home?
That might be a little bit too late. A little bit too late for that. So you still can deduct, on the expenses on the home, but that's really a little bit too late because that's reimbursement. That's reimbursement. So you have to be reimburse yourself. You have to prove you reimburse yourself, and also the reimbursement that comes from the employer employer. So that comes from the company. So that the company can deduct as expenses. So that's for the people have W-2 tax free. So that way you have to be careful because W-2 already issued, and also you need to back up all the reimbursement document for that.
Okay, thank you. This is questions from John Liu and says for 121, how many people can qualify with the same house? If three friends and I own the house, do we all qualify for the 250,000 exemption?
That's a very good question. That's a very good question. So for the section 121, there's no limit how many people qualify. So as long as is there on the title, is their primary home, they live there for 2 or 5 years as the primary home. So each of them qualify 250,000 on that. And also, as I mentioned, that if couple, so they don't need to be both of them live there for 2 or 5 years, as long as one day as the primary home and qualify for that. And that's one of the technique we might be advise the client, and we take a maximum capital gain deduction.
Okay, thank you. Again, this is from Vincent. Could step-up basis wipe out 1031 exchange deferred tax?
Right now, we can use like 1031 defer the tax again until the people go to heaven. Let me give you an example. So some scenario. So the same thing. Our house from Arcadia maybe purchased 50,000, and we sold at 1 million. And this is rental house, rental property. So we use the 1031 exchange to defer the tax. So that means that the gain 900,000, there's no tax, we defer. And then we sell again for 2 million and also 1031 exchange. So this portion we defer the capital gain. So when the owner go to heaven, and then the house is 3 million. So the kids will see the house, the cost basis with the step base 3 million. So that means that the house from 50,000 to 3 million by using 1031 exchange and step basis, and it's tax free. Yeah, so that's the tax break for the real estate on that. And hopefully President Biden won't change the tax break for this time, for this portion.
Okay, next question is from Sean. It says, question on 1031 exchange. For example, property in December 2020 and purchase in March 2021. Do I report on my 2020 return for 1031 exchange?
So I think one thing we all would know that is 45 days and 180-day rules. So Sean, I mean, one thing I would like to advise the client is file the extension as soon as possible, because the rule is 45 days or 180 days or the tax filing deadline, which is sooner. So if the tax filing deadline is April 15, and then this April 15 is not go through all the 180 days. So to answer the questions, that should be the sales is happened in 2020. So we file extension first, and then you complete the transaction, and we report in 2020 tax return. So just simple question, simple action, file extension, and wait for the transaction complete and report in 2020.
Okay, thank you. And next one's from Joanna Lin. I don't think that's a question, right? You put down income limitation on, I don't know, it's a question or just your explanation on income limitation. So let me go to Sophia Chan. And what if one of the properties go to, okay, hold on. Let me see, I lost a question. Hold on. Okay, what if one of the properties go to heaven, capital exemption still applies?
Okay, so one party go to heaven. So can I make assumption is for couple? So that couple depends. For the couple, if you own the title, husband and wife with right of survivorship. So that means that, and it will also automatic for the step up when other party go to heaven. So that's when we advise our client on how to own the title. And right now, if they have the choice, joint tenant or husband and wife, and with right of survivorship. So maybe we can suggest husband and wife with right of survivorship. It's better that way. We can get the step up basis for the other part when the other part go to heaven.
Okay, thank you. And this one for Sophia. What if one of the, oh no, this one I done already, sorry. How to prove we live in the house for total 2 years?
That's very good questions. When it comes down to the audit, so they will take a look like how many houses you own. So normally, if you have the bigger houses, maybe most likely it's your primary home. But there are some exceptions. So to prove that's your primary home, the first things you have to prove that you live there. So for your driver license, and you have proof that you use the address for the house, and also the utility, and also if you vote, maybe we will vote in your primary home area. So that way, yeah, also the proof you has the primary home.
Okay, the next question from Linda, it says on the same question 121, does the owner qualify if they live there in the first 5 years and rent it out, then sold it after own it for 20 years?
Yes. So if they live there as a primary home, they still qualify for 23,000 capital gain exemption for single and couple 500,000. But there's some catch. So since the house was rent out portion of the time, so as you mentioned, that is 20 years. So I make assumption maybe they rent out for 1 year. So that means that for the house, 95% is a primary home and 5% is a rental. So for the game, we split two parts. 95% on that portion. Since we live 2 or 5 years, we qualify the capital exemption. For 5%, since it's non-qualified, so we have to pay the capital gain on that portion on the rental time.
Okay, thank you. Another one from Sophia says, what if title shows one party but actually married couple have lived there for over 2 years? Do they still qualify for 500,000 capital gain exemption?
Yes. So as long as they live there for 2 years, 2 years they qualify. So those 2 years, you don't need to be consecutive. It can be like portion 1 year, portion the other year, as long as 5 years adds up together, and you have 24 months, you still qualify. Yeah.
Okay, this is about 1031 again. After from Joe, after you moved in the replacement house for 2 years, will the tax be reset from the replacement price, or you still need to pay the deferred tax?
So can I make sure that I get the questions right? So that's a scenario is we do the 1031 exchange and rent it out for 2 years, and later we live there for the primary home. Do I get this question right? Or I make sure that I understand the questions.
I don't quite understand either.
Okay, so let me use my scenario to make the explanation. So let me know if I don't answer your questions. So the question is, we use the 1031 exchange and rent them out for 2 years. And later we change the purpose from rental to primary home. So the first question for 1031 exchange is for the investment properties. That's for the rental property. So intentionally, it's for rental. So you rent them out for 2 years, and later, I mean, you change the purpose. That's I mean, is okay, is acceptable. It's acceptable. You change the purpose for. I mean, you move in as primary home. So that means that you still, if you live there for 2 or 5 years, you still qualify the category exemption for 500,000. So one thing I would like to draw attention, I do see that some people use the 1031 exchange. They exchange the investment property, and within 6 months, they move in as a primary home. That's not the case. I don't recommend. That's draw attention, because I mean, that's you show that your intention is not for the investment, your intention for primary home. So the 1031 exchange might not be existing if you move right away in 6 months.
Okay, thank you, Jeff. This is Joanna's questions, 3 questions she has. One is the income limitations on the child, if the child was born in 2020. And the second one is the limitations on the first time home buyer. Also the price house purchased, first time home buyer. Okay, this is one question. The second question is the maximum section 179 write-off. And the third question is, do you need evidence if deduct less than 1,500 for home office expense?
Okay.
Or if the deduction is less than 1,500 for home office expense. 3 questions there.
Okay, sorry, my question is, the first one, you say the child born in 2020, is that credit has limitation on the income of the parent? And the second one is the first time home buyers to qualify the credit, does that has an income limitation, and also the house of the price of the house they want to purchase? That's the question one. And the second one is the 179 write-off. Is there at a maximum, you can write off? And the third one is, if you only claim less than 1,500 for the home expense, did you need evidence on that? Sorry.
Okay, thank you. So let me answer the question one by one. The first question for the income limit for the newborn child to qualify the stimulus check. So the thing, the income, yes, there are legal income limits. For single is 75,000. For couple is 150,000. So for example, our total AGI for couple is 149,000, and that's less than 150,000. Yes, you qualify the stimulus check for the newborn baby in 2020. If you over 150,000, you still qualify for the credit, for the check, just portion. So every $100 you make above 150,000, and it's $5 less. So if with the max, and if you're around like 190,000 for couple, you won't get any credit for that. So that's when you prepare the 2020 tax return, and you can see that you can use the retirement and reduce the income. So that way, the kids might be qualified the full credit for the stimulus check. And also we have first round, second round, and third round also coming on the way. So that's the first question. And also we talk about the first time home buyer credit. And is this most likely, I mean, because the law haven't passed yet, so we don't have a defined rule. But my understanding, yes, they have income limit, definitely they have income limit. So they will helping the low income and middle income person to own the house. So we can stay tuned to take a look at when that law passed, and then they have more defined explanation on the rule there. So the second question is regarding the section 179 deduction. Yes, so the maximum you can deduct 1 million. But the thing is, the question is for like the real estate professional, we have to find all the equipment adds up $1 million. And also they had to be making profit to eligible to deduct on the 1 million. The third question is regarding the home office. So if we deduct, like as I mentioned, that we have single method, $5 per square feet. So the maximum for the year is 1,500. So to answer the questions for the home office, if no audit, everybody's happy. If they come down to audit, let me tell you what I was looking into that. So the first, home office, you don't need to have the separate room for the office, as long as it's a dedicated area. So you can be the corner of your living room. So in that corner, there should not have any personal stuff. So you should not have your pets toys in that corner. You came as the home office when the Thai us audit come to the home to audit whether you have a home office or not. So the answer questions is a dedicated home office.
Okay, next one from Claire Smith. How about the title is in family trust? Both parents, kids, and couples have been living together for over 2 years. Who qualified for Section 121 exemption?
Okay, so for the family trust, so first one we need to understand is a revocable trust or irrevocable trust. So let me answer the question in those two scenarios. First one, revocable trust. So revocable trust, that means that it still can change the living trust. So and revocable trust, I mean the parents still own the house. So the answer question still entitled for the capital gain exemption, 250,000 and or 500,000 for couple. So that's one scenario, revocable trust. The second scenario is for irrevocable trust. So irrevocable trust, that means that in irrevocable trust, they have their own tax ID. That's a different person, different entity. So irrevocable trust is saving estate tax, but not saving tax on the capital gain. To answer the question, in the second scenario, in revocable trust, there's no capital gain exemption, 500,000 in this case. So that way, when you set the family trust, you need to take a look like you want to save the estate tax or you want to save the capital gain tax.
Okay, thank you. This is the last question we have is from Joe. And after converting 1031 and moving in and as the primary home and staying for 2 years, do you still need to pay the previous 1031 deferred tax?
Yes, yes, very good questions. So as I mentioned that because I mean the home we have the rental, we have the rental. So rental is considered non-qualified. And also we have the primary home, which qualify 250,000. So we need to, first things, we need to calculate how much was the portion for the rental portion. So we have to calculate the rental portion, and for non-rent as a primary home, and we can use the 250,000 or 500,000 exemption. And also since the house is the 1031 exchange, so the cost basis had to be used the carry that the one we have original property. So that's carried to the cost basis. So that's we had to be like in this case, maybe we have to consider like we need to do the calculations, take a look how much tax we have to pay, and we need to plan ahead for these cases.
Thank you so much, Jeff, and thank you for all the questions you presented. Now back to Pauline.
Thank you, Jeff and Bernadette. What a wonderful section. Do you agree with me? We really learned how can we plan for a better 2021 tax matters. We want to thank again for on behalf of West and Gilbert Valley Realtors. Thank for CPA Jeff Huang for your informative and valuable presentation to us today. We hope to see you in person soon at our auditorium together. And a quick reminder for our next classes will be next Tuesday, March 9th at 12 noon, Commercial Lending 101 by Dolan Azura Capital. Please register all the classes at wsgbar.com. deductible.com and choose the education schedule. Let's learn together. And thank you again, Jeff, Bernadette, Huang, and all of you joined together to learn today. We see you next Tuesday at 12 noon.